How do you make sure you don't leave money on the table when selling your business? The best way to reduce this risk is preparation. By understanding common business valuation techniques, you'll have better understanding on what drives your business value. Even if you don't want to sell your business today, it's important to understand these concepts so you know the worth of your business to better plan for an eventual sale or to assess an unsolicited offer. There are three primary valuation methodologies to valuing a business: the discounted cash flow method, the Guideline public company method, and the Guideline transaction method. The discounted cash flow method is considered an income approach because it values the business based on the estimated future cash it will generate. Whereas the Guideline public company method and Guideline transaction method are market approaches to valuation because they value the company based on how comparable companies are trading in the stock market or were recently acquired for. It may be easier to think about this in terms of an investment real estate property. The income approach would value the property based on the future rents you're able to collect as the landlord of that property, whereas the market approach would value the property based on how other similar properties have sold for in the area. Let's look a little bit deeper into how these valuations work. The core principle of the income approach is time value of money, which means $1 today is worth more than $1 in the future. That's because $1 today can be invested to generate future returns. To calculate your business's value today under the income approach, we discount the anticipated future cash flow of your business to present value dollars using a discount rate in the discounted cash flow model. The discount rate is the return demanded by investors for taking on the risk of the investment. An investor will analyze your business to identify the risks and determine what rate of return they require to take on those risks. This is typically calculated as the weighted average cost of capital. There are two main valuation methods under the market approach. The Guideline public company method would value your company based on how comparable companies are trading in the stock market. We'll consider where these stocks are trading at as representative of what the market values companies in your industry, and then we apply those multiples to your business. For example, if you own a privately owned American fast food restaurant, we might consider how McDonald's or Wendy's public stock is trading to understand how the market is valuing similar companies. Typically, the comparable public companies are much larger and less risky companies and often trade at a premium, so we would apply a discount rate to their multiple before applying it to your business. This requires subjective analysis by a valuation expert. The Guideline transaction method will value your company based on how comparable companies were recently acquired for. We consider the multiples in these deals as representative of how the market values similar companies and then apply them to your business. Continuing with our fast food example, we might view the acquisition of Del Taco by Jack in the Box as a comparable transaction and analyze the terms of that deal. Again, this is probably a larger and less risky company compared to yours, so we'd apply a discount to that multiple before calculating your valuation. Buyer will often calculate the final valuation as an average of the three valuation methodologies. They do this so they're not putting too much weight into one methodology. There's many variables and factors that go into each one of these valuation techniques, so it would be prudent for them to look at all three of them as an average as opposed to relying just solely on one valuation. Now that you know the three most common valuation methodologies that a buyer will use to value your business, you can perform these similar analysis to estimate what your company's worth. It's important to know this information so you can better assess unsolicited offers and be better prepared to evaluate those offers. It'll help you set realistic expectations on what you can generate from selling your business. Thanks for joining me today, and I hope you found this information useful. If you like this video, please subscribe to our YouTube channel so you'll be notified whenever new content is posted.